Question 1. Topic: Risk management principles. Which of the following best explains why a captive insurance company might retain certain risks rather than transferring them to a reinsurer? A. To ensure compliance with statutory accounting principles, SAP. B. To avoid the administrative burden of reinsurance reporting. C. To reduce overall insurance costs by minimizing premium payments. D. To increase capital reserves and improve solvency ratios. Answer: C. To reduce overall insurance costs by minimizing premium payments. Explanation: retaining risks allows captive insurance companies to avoid the premium costs associated with transferring risks to reinsurers. This approach can reduce the overall cost of coverage provided the captive has sufficient capital and reserves to handle potential claims. Option is incorrect because SAP compliance is not directly impacted by the decision to retain or transfer risks. Option B is incorrect as administrative efficiency, while a factor, is not the primary reason captives retain risks. Option D is incorrect because retaining risks does not directly increase capital reserves, it merely avoids the expense of reinsurance premiums. This concept aligns with the principle of risk retention, where a captive balances potential savings against the need for adequate capital and reserves to manage claims independently. Question 2. Scenario-based. Topic: Formation and structure of captive insurance companies. Laura is the CFO of a mid-sized manufacturing company exploring the feasibility of forming a captive insurance company in Ohio. During the feasibility study, the actuarial team recommends a minimum capital of $1 million based on projected claims and operational needs. Laura wants to use the captive to cover both general liability and workers' compensation. What should Laura prioritize to ensure the successful formation of the captive insurance company in compliance with Ohio regulations? A. Ensure the captive is structured as a limited liability corporation (LLC) to minimize taxes. B. Conduct a detailed actuarial analysis and file the required capital and surplus with the Ohio Department of Insurance. C. Focus on drafting policies that align with existing reinsurers' terms to simplify reinsurance. D. Obtain a letter of credit from a bank to meet Ohio's solvency requirements instead of contributing cash capital. Answer: B. Conduct a detailed actuarial analysis and file the required capital and surplus with the Ohio Department of Insurance. Explanation: the Ohio Department of Insurance OD mandates a detailed feasibility study including actuarial analysis to determine the adequacy of the captive's capital and surplus. Filing these details is critical for obtaining the necessary license to operate in compliance with Ohio law. Option A is incorrect because Ohio does not require captives to adopt a specific corporate structure like LCA. The choice of structure depends on operational needs. Option C is incorrect as reinsurance terms are secondary to meeting initial regulatory and capital requirements. Option D is misleading. While letters of credit can be used to meet solvency requirements, they must be explicitly approved by the ODI and may not replace all capital contributions. This question tests the understanding of Ohio-specific licensing requirements and the importance of adhering to statutory guidelines for captive formation. Question 3. Topic: Accounting and financial management. A captive insurance company reports its financials under statutory accounting principles, SAP. Which of the following practices aligns with SAP's focus on solvency and conservatism? A. Recognizing unearned premium reserves as revenue to enhance profitability. B. Underestimating reserves to improve short-term financial ratios. C. Maintaining reserves for incurred but not reported IBNR claims. D. Adjusting asset valuations upward to reflect current market trends. Answer: C. Maintaining reserves for incurred but not reported IBNR claims. Explanation: statutory accounting principles, SAP, prioritize solvency and the protection of policyholders. Maintaining reserves for IBNR claims ensures that sufficient funds are available to cover potential future claims even if they have not yet been reported. Option is incorrect because recognizing unearned premium reserves as revenue violates SAPA, which requires a clear distinction between earned and unearned premiums. Option B is incorrect as underestimating reserves jeopardizes solvency and violates the conservative nature of SAP. Option D is incorrect because SAP generally does not permit upward revaluation of assets to reflect market trends, focusing instead on maintaining stability and solvency. This question emphasizes the importance of adhering to conservative financial principles under SAP, critical for ensuring captive viability and compliance. Question 4. Topic: Ohio-specific captive insurance regulations. Under Ohio law, which of the following activities is explicitly prohibited for a captive insurance company? They writing direct policies for its parent company's liability exposures. B. Acting as a reinsurer for risks written by another insurance company. C. Writing life insurance policies directly for third-party individuals. D. Managing its investments internally without an external investment advisor. Answer: C. Writing life insurance policies directly for third-party individuals. Explanation: Ohio law restricts captive insurance companies from writing life insurance directly for third parties, as captives are primarily designed to address specific commercial or organizational risks for their parent or associated entities. Option A is allowed, as captives are often established to provide direct coverage to their parent company. Option B is permissible under Ohio regulations, provided the captive complies with the necessary reinsurance agreements. Option D is allowed, though captives must ensure their investment practices align with regulatory requirements for solvency and risk management. This reflects the limitations imposed by the Ohio Revised Code and ODI regulations on permissible activities for captives. Question 5. Topic: Industry trends and emerging issues. What is one of the key challenges captives face when addressing emerging risks such as cybersecurity? A. Lack of actuarial data for accurate pricing of coverage. B. Inability to secure reinsurance for non-traditional risks. C. Regulatory restrictions on underwriting cyber-related policies. D. High levels of competition from traditional insurers in the cyber market. Answer: A. Lack of actuarial data for accurate pricing of coverage. Explanation: Emerging risks like cybersecurity often lack historical claims data, making it challenging for captives to price coverage accurately and establish appropriate reserves. Option B is incorrect, as many reinsurers are open to covering non-traditional risks if proper underwriting and risk assessment are conducted. Option C is incorrect, since regulatory restrictions generally do not prevent captives from underwriting cyber risks. Option D is misleading, because captives are usually formed to address gaps or inefficiencies in traditional insurance markets, not compete directly. This question highlights the innovative role of captives in managing emerging risks and the challenges they face in doing so. Question 6. Scenario-based. Topic: Operational aspects of captive insurance. David manages a captive insurance company based in Ohio. A recent ransomware attack affected one of the policyholders covered by the captive. The policyholder files a claim under their cyber insurance policy. David realizes the captive does not have a specific claims adjudication process for cyber incidents. What should David do first to handle this situation effectively? A. Deny the claim, since there is no pre-established process for handling it. B. Engage an external claims adjudicator with expertise in cyber insurance claims. C. Expedite payment of the claim to maintain the policyholder's trust. D. Refer the claim to the Ohio Department of Insurance for resolution. Answer: B. Engage an external claims adjudicator with expertise in cyber insurance claims. Explanation: Captives must ensure claims are handled competently and fairly to maintain their reputation and meet regulatory standards. For specialized risks like cyber incidents, engaging external experts ensures the claim is assessed accurately. Option A is incorrect, as denying the claim without due diligence could lead to legal and reputational issues. Option C is incorrect, because paying the claim without proper adjudication risks financial mismanagement. Option D is not applicable, as the Ohio Department of Insurance oversees compliance but does not resolve individual claims. This scenario tests the understanding of claims management processes and the importance of specialized expertise in operational aspects. Question 7. Topic: Formation and structure of captive insurance companies. Which of the following is a primary consideration during the feasibility study for forming a captive insurance company? A. The anticipated level of participation from reinsurers. B. The tax benefits of the captive's jurisdiction. C. The adequacy of projected premium and loss funding. D. The ability to outsource daily operations to third-party providers. Answer: C. The adequacy of projected premium and loss funding. Explanation: A feasibility study must determine whether the captive can sustain itself financially by projecting sufficient premiums to cover potential losses, operating costs, and regulatory requirements. Option A is secondary, as reinsurance participation depends on the captive structure and risk profile. Option B is relevant but not the primary focus of feasibility studies, which prioritize financial and operational viability. Option D is incorrect, since outsourcing decisions are typically addressed after the captive's formation. This question examines critical aspects of planning and evaluating the sustainability of a captive. Question 8. Topic: Accounting and financial management. Which of the following actions is considered a violation of statutory accounting principles (SAP) for captive insurance companies in Ohio? A. Reporting assets at their historical cost rather than fair market value. B. Including uncollected premiums as part of admitted assets. C. Exceeding state-regulated limits on reinsurance recoverables. D. Delaying reserve adjustments until the fiscal year end. Answer: D. Delaying reserve adjustments until the fiscal year end. Explanation: SAP emphasizes solvency and requires timely adjustments to reserves to reflect current liabilities. Delaying these adjustments undermines the accuracy of financial statements. Option aligns with SAP, which typically requires conservative asset valuation. Option B is permitted as long as the uncollected premiums meet criteria for admitted assets. Option C is misleading because exceeding reinsurance recoverable limits is a regulatory issue, not a direct violation of SAP. This question reinforces the need for captives to adhere to strict financial management principles. Question 9. Topic: Legal and ethical considerations. Which of the following best describes a fiduciary duty of captive insurance company directors under Ohio law? A. Prioritizing the profitability of the parent company over all other considerations. B. Ensuring the captive operates in compliance with Ohio Department of Insurance regulations. C. Transferring the maximum amount of risk to reinsurers to minimize the captive's exposure. D. Securing the parent company's assets as collateral for captive operations. Answer: B. Ensuring the captive operates in compliance with Ohio Department of Insurance regulations. Explanation: Directors of captives have a fiduciary responsibility to ensure compliance with Ohio regulations and to act in the best interests of the captive stakeholders, including policyholders and regulators. Option A is incorrect because directors must balance profitability with regulatory and ethical obligations. Option C is incorrect as risk transfer strategies depend on the captive's goals and financial position, not fiduciary duty. Option D is misleading as collateral arrangements are not typically a fiduciary responsibility. This question tests understanding of directors' legal and ethical obligations. Question 10. Topic: Specialized coverage options. Why might a captive choose to include workers' compensation coverage in its program? A. To reduce claims reporting requirements under federal laws. B. To centralize risk management and reduce premium volatility. C. To avoid state-specific workers' compensation mandates. D. To eliminate the need for actuarial reserve calculations. Answer: B. To centralize risk management and reduce premium volatility. Explanation: Captives often include workers' compensation coverage to provide more predictable costs and greater control over claims management, ultimately reducing premium volatility for the parent organization. Option A is incorrect as federal laws still apply to claims reporting regardless of coverage type. Option C is incorrect because captives must comply with state-specific mandates, including workers' compensation requirements. Option D is incorrect as captives are required to conduct actuarial reserve calculations for all covered risks. This question emphasizes the strategic benefits of including workers' compensation in a captive program. Question 11. Topic: Risk retention (RRGS) and Ohio regulations. What is a primary distinction between a captive insurance company and a risk retention (RRG) under Ohio law? A. RRGS are subject to federal regulation, while captives are not. B. RRGS can only write liability insurance, while captives can write diverse coverage types. C. Captives must be licensed in all states where they operate, while RRGs do not require licensing. D. Captives are prohibited from offering reinsurance, while RRGs are not. Answer: B. RRGs can only write liability insurance, while captives can write diverse coverage types. Explanation: RRGs are limited to providing liability coverage and are regulated under the Federal Liability Risk Retention Act. Captives, however, have flexibility in the types of coverage they offer. Option A is partially correct but does not address the primary distinction. Option C is incorrect as captives are domiciled in one state and operate under that state's regulatory framework, while RRGs are subject to federal preemption regarding multi-state licensing. Option D is false because captives can offer reinsurance. This question highlights the differences in coverage scope and regulatory structure between captives and RRGs. Question 12. Topic: Taxation of captive insurance companies. What federal tax benefit is typically sought by small captive insurance companies qualifying under IRS Section 831? B. A complete exemption from federal income taxes. B. Exclusion of investment income from taxable revenue. C. Taxation only on investment income, not underwriting profits. D. Deduction of all premium payments made by the parent company. Answer: C. Taxation only on investment income, not underwriting profits. Explanation: under IRS Section 831(b), small captives can elect to be taxed only on investment income, making underwriting profits tax-free. Option A is incorrect because captives are not entirely exempt from taxes. Option B is misleading as investment income is still taxable under Section 831(b). Option D applies to the parent company but not directly to the captive's taxation. This question examines the financial benefits available to small captives under federal tax law. Question 13. Topic: Captive governance under Ohio law. Which of the following governance requirements is mandatory for a captive insurance company? A. Annual submission of audited financial statements. B. Appointment of a board comprised solely of independent directors. C. Implementation of a whistleblower protection program. D. Public disclosure of all operational reports. Answer A. Annual submission of audited financial statements. Explanation: Captive insurance companies are required to submit annual audited financial statements to ensure transparency and regulatory compliance. Option B is incorrect because Ohio does not mandate all directors be independent. Option C is not specifically required, although good governance practices may include whistleblower protections. Option D is incorrect as captives are not subject to public disclosure requirements. This question tests understanding of regulatory governance requirements. Question 14. Scenario-based. Topic: Policyholder needs a manufacturing company forms a captive insurance company in Ohio to cover property risks at multiple facilities. During the first policy year, a tornado damages one facility, leading to claims that exceed initial projections. What action should the captive take to address this financial strain? A. Seek additional premium contributions from the parent company. B. Use reinsurance agreements to offset the unexpected claims. C. Deny claims that exceed the original projected limits. D. Restructure its policies to exclude future tornado-related losses. Answer: B. Use reinsurance agreements to offset the unexpected claims. Explanation: Reinsurance allows captives to transfer risk and mitigate financial strain from unexpected large claims. Option A may be a last resort but is less effective than leveraging reinsurance. Option C is incorrect as valid claims must be honored. Option D is impractical and might expose the captive to regulatory scrutiny. This scenario evaluates the role of reinsurance in risk management. Question 15. Topic: Captive formation costs. Which of the following represents a typical cost associated with forming a captive insurance company? A. Initial capital deposit required by the state of domicile. B. Premium taxes on third-party business underwritten. C. Brokerage fees for purchasing policies from traditional insurers. D. Claim settlement fees paid to third-party administrators. Answer A. Initial capital deposit required by the state of domicile. Explanation: States require captives to meet minimum capital requirements as part of the formation process. Option B applies during operations, not formation. Option C is irrelevant as captives write their own policies. Option D is operational, not a formation cost. This question highlights financial prerequisites for captive establishment. Question 16. Topic: Risk financing strategies. What is a primary benefit of using a captive for risk financing? A. Avoidance of all state regulatory oversight. B. Immediate access to federal catastrophe relief funds. C. Retention of underwriting profits within the parent organization. D. Reduction in operational costs through outsourcing claims. Answer: C. Retention of underwriting profits within the parent organization. Explanation: Captives allow their parent company to retain underwriting profits rather than paying them to traditional insurers. Option is false as captives are regulated by their domicile state. Option B is irrelevant to captive financing. Option D is a cost management strategy, not a primary benefit. This question tests understanding of strategic financial advantages. Question 17. Topic: Investment practices under Ohio law. Which type of investment is typically restricted for captives? A. High-risk speculative derivatives. B. Investment-grade corporate bonds. C. Real estate for operational purposes. D. Government securities issued by other states. Answer A. High-risk speculative derivatives. Explanation: Captives must adhere to conservative investment practices to maintain solvency, and speculative derivatives are often restricted. Option B and Option C are permissible under certain conditions. Option D is allowed if the securities meet regulatory standards. This question emphasizes prudent investment practices for captives. Question 18, topic: Multi-state operations. How does federal law impact the operation of a captive insurance company across state lines? A. Captives are exempt from all state insurance regulations outside their domicile. B. Captives must comply with premium tax requirements in non-domicile states. C. Captives automatically gain approval to operate in all 50 states. D. Federal law prohibits captives from insuring risks outside their domicile. Answer: B. Captives must comply with premium tax requirements in non-domicile states. Explanation: although captives operate under their domicile's regulations, they must pay premium taxes on risks insured in other states. Option A and Option C are incorrect as state laws govern non-domicile operations. Option D is false as captives can insure multi-state risks. This question evaluates knowledge of regulatory compliance in multi-state operations. Question 19, topic: Emerging risks. What is one challenge captives face when insuring emerging risks like climate change? A. Lack of demand from policyholders. B. Absence of state regulatory approval. C. Difficulty in modeling and pricing risks accurately. D. Prohibition on reinsuring catastrophic losses. Answer: C. Difficulty in modeling and pricing risks accurately. Explanation: emerging risks often have limited historical data, complicating accurate risk assessment and pricing. Option A is false as there is increasing demand for such coverage. Option B is incorrect as most states support captives addressing new risks. Option D is irrelevant as captives can purchase reinsurance for catastrophic losses. This question focuses on challenges in adapting to new risk landscapes. Question 20, scenario-based. Topic: Financial health monitoring. A captive has experienced 2 consecutive years of underwriting losses and a decline in surplus. What should be the captive's priority to restore financial health? A. Request a reduction in regulatory capital requirements. B. Implement a stricter claims review process to reduce payouts. C. Reassess premium rates and reinsurance arrangements. D. Shift focus to more profitable but unrelated lines of business. Answer: C. Reassess premium rates and reinsurance arrangements. Explanation: adjusting premiums and optimizing reinsurance can help stabilize finances without compromising service quality or compliance. Option A is not feasible as regulators are unlikely to reduce capital requirements during financial strain. Option B risks alienating policyholders if claims are denied unfairly. Option D diverts from the captive's primary purpose and regulatory framework. This scenario tests understanding of strategic decision-making for financial recovery. Question 21, topic: Types of captives. Which of the following best describes a pure captive insurance company? A captive that writes insurance for multiple unrelated entities. B. A captive that insures risks exclusively for its parent company and affiliates. C. A captive formed by a group of companies to share risk. D. A captive that operates as a reinsurer for third-party insurance companies. Answer: B. A captive that insures risks exclusively for its parent company and affiliates. Explanation: a pure captive primarily serves its parent company and affiliated entities, providing tailored coverage for specific risks. Option: it describes an association or group captive. Option C refers to a group captive. Option D describes a reinsurance captive. Question 22, topic: Captive formation process. What is the first step in forming a captive insurance company in Ohio? A. Submitting an application to the Ohio Department of Insurance. B. Obtaining approval for the business plan and feasibility study. C. Hiring a third-party administrator to manage claims. D. Securing reinsurance agreements for excess risk coverage. Answer: B. Obtaining approval for the business plan and feasibility study. Explanation: a feasibility study is critical to demonstrate the captive's viability and is usually reviewed by the state Department of Insurance before granting licensure. Option A follows the business plan approval. Option C and Option D are operational steps that occur later. Question 23, topic: Risk retention guarantee regulations. What is a key limitation of risk retention guarantees under federal law? A. They cannot operate outside their state of domicile. B. They are restricted to providing liability insurance only. C. They are required to purchase reinsurance from traditional carriers. D. They cannot insure risks for non-member companies. Answer: B. They are restricted to providing liability insurance only. Explanation: ROGS can only write liability insurance as specified under the Federal Liability Risk Retention Act. Option is incorrect because ROGS can operate across state lines. Option C is false. Reinsurance is not a mandatory requirement. Option D is partially correct but not the primary limitation. Question 24, topic, regulatory capital requirements. Under Ohio law, what happens if a captive fails to maintain its minimum capital requirements? A, the captive is dissolved automatically. B, the captive's license is revoked by the Department of Insurance. C, the parent company must immediately inject additional funds. D, the captive is barred from writing new policies but may service existing ones. Answer: B. The captive's license is revoked by the Department of Insurance. Explanation: regulatory authorities require captives to maintain minimum capital to ensure solvency and protect policyholders. Failure to comply can lead to license revocation. Option is false. A dissolution is not automatic. Option C is not mandatory but often occurs to remedy shortfalls. Option D may occur temporarily but does not replace the need for compliance. Question 25, scenario-based. Topic: risk financing. A parent company operating in a volatile industry uses its captive to cover business interruption losses. A geopolitical event causes a significant supply chain disruption, triggering multiple claims. What action should the captive prioritize? A. Raise additional capital by issuing debt. B. Review policy terms to exclude future geopolitical risks. C. Engage with reinsurers to offset the financial burden. D. Delay claim payments to preserve cash flow. Answer: C. Engage with reinsurers to offset the financial burden. Explanation: reinsurance is a key strategy to transfer large risks and ensure the captive's financial stability during significant events. Option A may be a long-term solution but is not immediate. Option B would apply for future policies but not current claims. Option D could lead to reputational damage and regulatory issues. Question 26, topic, captive taxation. Which of the following is a common federal tax compliance requirement for captives? A. Filing Form 1120-PC with the IRS. B. Applying for tax-exempt status under Section 501. C. Maintaining separate tax filings for each policy issued. D. Reporting all investment income as underwriting profit. Answer: A. Filing Form 1120-PC with the IRS. Explanation: Form 1120-PC is used by insurance companies, including captives, to report income, deductions, and tax liability. Option B is incorrect, as captives do not typically qualify for tax-exempt status. Option C is false. A captives file a consolidated tax return. Option D misrepresents tax reporting requirements. Question 27, topic, captive management. Which of the following is typically outsourced by captives to third-party service providers? A. Issuing licenses for new policies. B. Developing the captive's business plan. C. Performing claims administration and processing. D. Setting premium rates for affiliated companies. Answer: C. Performing claims administration and processing. Explanation: claims administration is a common outsourced function to ensure efficiency and expertise. Option O and Option B are regulatory and strategic tasks handled internally. Option D involves actuarial expertise but is usually done in collaboration with the captive manager. Question 20, topic, fronting arrangements. Why might a captive insurance company enter into a fronting arrangement with a traditional insurer? A. To reduce operating costs by delegating all functions. B. To comply with regulatory requirements in non-domicile states. C. To avoid underwriting high-risk policies. D. To expand into international markets without licensing. Answer: B. To comply with regulatory requirements in non-domicile states. Explanation: fronting arrangements allow captives to access regulated markets by using a licensed insurer as a front. Option A is incorrect. Captives still handle certain operational functions. Option C is false, as captives use reinsurance for risk transfer. Option D is partially true but not the primary reason for fronting. Question 29, topic, captive advantages. What is a primary advantage of using a captive for insuring employee benefits? A. It eliminates the need for third-party claims administrators. B. It reduces reliance on state-mandated insurance pools. C. It allows customization of coverage tailored to workforce needs. D. It exempts the parent company from federal employment laws. Answer: C. It allows customization of coverage tailored to workforce needs. Explanation: Captives offer flexibility in designing employee benefit plans to align with specific organizational goals. Option is incorrect. Third-party administrators may still be used. Option B is unrelated to employee benefits. Option D is false, as captives must comply with federal laws. Question 30, scenario-based. Topic: loss reserves. A captive insurance company in Ohio underestimates its loss reserves for workers' compensation claims, leading to shortfall. What is the most appropriate corrective action? A. Revise financial statements and notify regulatory authorities. B. Transfer funds from unrelated accounts to cover the shortfall. C. Seek additional reinsurance to retroactively cover prior claims. D. Halt claims payments until reserves are replenished. Answer A. Revise financial statements and notify regulatory authorities. Explanation: transparency and regulatory compliance require captives to correct errors in reserve estimates and inform relevant authorities. Option B could violate accounting principles. Option C is not feasible, as reinsurance cannot apply retroactively. Option D would breach contractual obligations.